I am going to take a small case in this. Supposing the interest rates in the markets have risen to 10%. But what happens? You will continue to get a coupon on this bond at $80 for 10 years. 1 year after, no, this is okay now. Next. Let us supposing I say that 1 year after the bond has been issued, the market interest rates rise to 10%. That means the bond has a life of 9 more years to maturity. 9 more years to maturity. Now the fellow who has bought a bond last year, which has a coupon rate of 8%, and market also had 8% coupon, market also had expected return of 8%, he is now wanting to sell the bond after end of 1 year. He needs money. But the bond has a life of 9 years. For the next 9 years, you are going to get $80, $80, $80, $80, $80. For the next 9 years, I am going to get $80 on that bond out there. And in the 9th year, I am going to get $80 plus $1,000. And in the 9th year, I am going to get $80 plus $1,000 of the coupon. And this is what I am going to get. Now, you are buying the bond at the end of 1 year with a life of 9 years. What price will you buy the bond? Same aspect what we did in the last. Same aspect what we did out there. First, let me find out the face value of the bond. Face value, present value of the face value. The face value I am going to get at the end of 9 years. Let me say, what is my expected return? My expected return in this particular case is 10% out there. Yes. What is the, now how many years I am going to get after? 9 years is what I am going to get this money after. So what is the present value of the face value? The present value of the face value, yes, I have calculated. Now what is the present value of the annuity? Annuity is $80 every year I am going to get for 9 years. 9 years. Present value of the annuity. Let us look at in this particular case. My coupon is in this particular case is $80. My expected return is 10% out there. C by 10 into 1 minus, yes, and then into what is called as 1 divided by 1 plus 10% out there to the power of 9 in this particular case, because my number of years is only 9 because 1 year has already lapsed when I bought this bond out there. And then I close it. Now let us sort of look at in this particular case what is the bond out there. So what happens? Present value of the annuity is 460. And I am going to buy this bond at a total value of about 884.82. So what happens? When the interest rate rises, you will buy the bond at a discount out there. You will buy the bond at a discount out there. That is your expected return, your expected yield, what you are expecting on the bond is higher. Supposing the interest rate drops to 6%, I am sorry about the typo out here, let me correct the typo out here, from 10 it is to 6% out there. The bond basically did not move to 10, it moved to 6% out there. Now, I mean the interest rates in the market moved only to 6% out there. Then what happens? How does it work? How does it work out there? Let us sort of try and see if we can calculate it. Same thing, I am going to look at, I am going to look at the present value of the face value out there. The present value of the face value, I am going to have this divided by 1 plus R. R in this particular case is 6% to the power of 9 out there, because that is all what I am going to have. 9 years is what I am going to wait for getting the principal amount, and that is it. What is the present value of the annuity? Present value of the annuity out here in this particular case $80 is what I am going to get, divided by my R, that is my 6%, into what we call it as 1 minus in this particular case 1 divided by your 1 plus 6% out here to the power of 9 out here is what we are looking at. in this particular case out there. We are basically looking at in this particular case. And with that, I'm basically closing this issue out there, and yes, that is basically what happens. Then you will buy the bond, as you see is 1136.03, you will buy the bond at a premium out there. You will buy the bond at a premium out there. So this is what is with bond valuation. How do you bond pricing, bond valuation equation out there. In terms of bond concepts, if bond prices and market interest rates move in opposite direction. When coupon rate is equal to yield to maturity, what is expected, bond will sell at par. When coupon rate is more than the yield to maturity, then the bond will sell at a premium, as you saw. If coupon rate is less than yield to maturity price, the bond will sell at a discount out there. Then after concept, we will move to computing yield to maturity. The next basic aspect. How do we compute yield to maturity in this case? We can use, of course, a financial calculator and so on and so forth. We can also do it by little bit of trial and error if you don't have a financial calculator, etc. Let us take one example out here. Supposing we are interested in a 6-year 8% coupon bond out there. 6-year 8% coupon. The bond does have a coupon rate of 8%. It has 6 years life. 6 years life left. I don't know what is the tenure of the bond. Let's not leave it. The broker quotes a price of 955.15. What is the yield on the bond out there? The same equation. What is the yield on the bond out there? What is the yield on the bond on this bond? Let's go back to the same equation out here. The bond value, what we talked about, and what I calculated in Excel. The present value of the face value, that is what is the second part, and the annuity part. Annuity, present value of the annuity. So when we use the same concept out there, I fix the same thing. In this case, the bond price is known, R is unknown, R is the return rate is unknown, market, what is called as the coupon on the bond is known, but the expected price, return in the market out there, market return out there, whatever is expected return in the market is unknown. But price of the bond is fixed out there at 955. So you can calculate, fix the same equation, calculate R as you see. We see that at about it's by little bit of trial and error you can try. It's somewhere between 9 and it's somewhere between about what do you call it as 8 and 10% out there. 8 and 10. So in the same equation, now I know that the bond is selling at a discount, 955.14. It's a $1,000 bond. When will the bond sell at a discount? The bond will sell at a discount when the YTM, the yield to maturity, the expected return on the bond is higher than the coupon rate. That is when it will sell at a discount. The broker himself is offering to me at a discount. That means he knows the coupon rate on the bond is not up to the expectation of the market interest rate as of today. So he is offering at a discount. So is it anywhere between 8 and 10? 8% is the coupon. It should be higher than 8. Can it be 9? Can it be 10? Well, I can just do a little bit of trial and error trying to fix in the same equation, and I say that the YTM in this particular case is almost about 9% out. So slight bit of trial and error out there. We have some numericals. We will sort of try and see if we can solve some of the numericals out. Whereas when you talk about the next thing, YTM, after YTM, I will talk about the current yield out. What is the current yield? The annual coupon divided by the price of the bond out there. That is all what will give you what is the current yield on the bond out there. Supposing the bond is selling at par 1,000, the coupon is $80 annually. 80 divided by the face value of the bond, 1,000. Now that will basically give me what you call it as the current yield. It will be the same 8%. The bond is selling in this case at 955.14. That is what we saw in the previous example, 955.14. Bond is giving me a coupon of $80 every month. So what is the current yield? 80 divided by 955.14. They can say that it's about 8.38 out there, little less than the YTM. Why is it less than the YTM out there? In this particular case out there, as you can see, because when you are talking about YTM, yield to maturity, we are talking about the yield from the date of purchase till the date of maturity. In this particular case, the bond has a life of 6 more years. So when I say accumulate 6 years out there, because I am not looking at an individual year, the first year return, second year return, third year return, fourth year return, fifth year return, sixth year return of the bond plus the principal that gets repaid. If I combine all that, that is, then I take that yield out there, that is where yield to maturity out here. Current yield is only at this particular point in time out there. This is what we call it as the current yield out there. Now we can say discount bonds. Current yield is too low, and is that it is only considered as a coupon, that is what you can see, portion of the return. It does not consider the built-in gain from the price discount. Built-in gain means till the repayment of the principal out there, but because even the principal is getting discounted at 12%, as you saw in this basically the whiteboard what I used out there. Even here you can see even the principal got discounted at 8% or 12% or whatever the percentage what I basically sort of looked at in this particular case out there. Premium bond current yield will be higher because it ignores built-in losses out there. It ignores what is called as built-in loss. That's perfectly all right. Let's not get into the too much of details of that. Then we have what is called as pure discount or zero coupon bonds or deep discount bonds. Deep discount bonds, number one, will not have a coupon rate. Will have a tenure, but will have no coupon. It will have no interest payment mentioned every year or whatever it is. It is one lump sum payment that happens at the end of the tenure of the bond. Now, you will buy the bond at a price out here. I am going to say, it's a deep discount bond. I will give you $1,000 at the end of 10 years. And you know the risk profile. So then what is the price at which you will buy? For similar risk profile, instruments are offering me 7% interest. Then what happens? The $1,000 what I am going to give you at the end of 10 years in the zero coupon bond, you will discount it at 7% for 10 years. I am offering a bond. I say that at the end of 10 years, I am going to give you $1,000. Now buy it at any price you want. What is the price you will buy? I look at the market today. For a similar risky instrument, I am getting 7% return in the market. Then what happens? 7% is my expected return. Then the bond that you offered, zero coupon bond that you offered, where you are going to pay me $1,000 at the end of 10 years, I will discount it for 10 years at the 7% out there, because 7% is the current interest rate in the market. So whatever is the number I will arrive, I will buy the bond at that particular price out there. I will buy the bond at that particular price. Please note, zero coupon bond can never sell at a price which is more than the par value of the bond out there. These are also called as pure discount bonds. Time to maturity for your face value and discount rate. Face value is the money that you are going to get at the end of the tenure out there. Is all these three are important in that particular case out here. I have just tried to build an example out here. So how do we do it? Present value is whatever the future you are going to get face value 10 years down the line divided by, I discount it for the specific time period out here. That's all what we are looking at in this case. A 30-year zero coupon bond, 1000 is the par value. YTM is 6%. YTM is 6%. That yield to maturity today in the market is 6%. So what is the price at which you will buy this bond? 1000 divided by 1 plus 6% to the power of 30. That's all. 1000 divided by 1 plus 6% to the power of 30, and that's all what you will do, and that will be, you will buy this bond at 174.11 if your expected return is 6%. Yield to maturity in the market is 6%. Of course, this can also be calculated using some spreadsheets out there. Let me go to the spreadsheets out there. I've got some Excel calculations also. I've tried to do it without Excel. I'll try to see with the Excel function out here. Let's take this. Settlement date 1/1/2015. Maturity date 1/1/37. Coupon rate 8%. Yield to maturity 9% YTM. Face value $100. Coupons are twice a year, that is every 6 months you are going to get money. The bond price, percentage of par, it is at about, it's selling at 90.49, that is why yield to maturity is 9%. It's selling at a discount, so yield to maturity is 9%. Use an Excel function, I can calculate the price. How can you calculate the price using Excel function? Let us sort of try and see if we can do that. I'm just going to copy this part of it into an Excel sheet and let us try and see if we can build it out here. Let us say settlement date 1/1/15, maturity date 1/1/37, annual coupon 8%, bond price 96 point annual coupon 8%, yield to maturity 9%, or I will say 9%. Face value $100. Coupons per year 2. Now, what is the price of this bond out there? All I do is I can use an Excel function. I can just say price it says, you can see settlement, maturity, rate, yield, redemption, frequency. Settlement, I'm sorry, I think I'm going wrong. It says settlement, maturity, rate, yield, redemption is the face value, and then frequency is number of coupons out there. All I will do this frequency, and that will give me 90.49. So, I can buy this bond at about 90.49. If I can buy the bond, that is the bond price at par. You can actually see that that is the answer what we see in the Excel sheet and in the spreadsheet calculation out there, 90.49. I basically got the same number. So, similarly, bonds you can use a spreadsheet and basically look at the bond value. You can also use the spreadsheet and say YTM also you can do, yield to maturity. We can try and do that same thing, yield to maturity also. I can do that also, yield to maturity in this particular case. Yield to maturity also we can try and if we can calculate out there. I am just going to paste it out here, yield to maturity. So, what is that? Let us say I am just going to use this. I am just going to keep making changes in this. I am just going to copy it and paste it out there. Settlement date 1/1/5, maturity days is okay, coupon rate is this. Now, what happens? Bond price is about 96.017. Yes, I have taken that, not as a percentage. Then face value is over. Coupon is, this is to be formatted in a different size. Okay. Then the coupon is fine. And then what do you call it as? You got to find out what is yield to maturity, YTM. All I need to do is yield it says, you can see in the screen, settlement, comma, maturity, comma, rate, yes, PR, that is the price of the bond, yes, redemption value 100, frequency $2 out there and 2 twice out there, and that's it. My yield to maturity is 0.0842. I can just express it in the form of percentage. It is 8.40%, and that's exactly what you see on the screen out there. We can do it that way also. Typically, how is it reflected? This is how bonds get reported. I've just picked up an NSE terminal from the NSE terminal, one of the screenshots out there. I've just described descriptor out there. You can see that entire list of bonds out there. That is Small Industry Development Bank of India. This is the bond descriptor, weighted average price. This is the last traded price. This is the weighted average yield, last traded yield, annual price, and so on and so forth, number of times. This is typically how it is being reported out there. So, overall, what you have got as of now, as far as the bond is concerned, is we talked about YTM, what is yield to maturity, what is the current yield, how do you value the bond, and how is bond price related to the interest rates in the market. That's it. After that, now the next session we will take up stock valuation. Thank you.